Your first step into options trading. Hello friends. Today we are going to learn about a very interesting and powerful tool in the stock market called the option chain. Now I know the name might sound a bit complicated, but trust me, it's much simpler than you think. Imagine you are going to a big vegetable market. You see different vegetables, and for each vegetable there are many sellers, each quoting a slightly different price. You can see the price, how many people are interested in buying, and how much is available to sell. An option chain is just like that big market, but for options contracts of a particular stock or index, like Nifty or Reliance. It's a list of all available options for a given security. So, where can you find this magical list? It's very easy. You can find the option chain on the website of the stock exchange, like the National Stock Exchange of India. Many stockbroking platforms like Zerodha, Upstocks, or Angel One also provide this data in a very user-friendly format. The option chain simply shows you all the possible option contracts you can trade for a specific expiry date. It is a snapshot of all the action happening in the options market for that stock. Think of it as a menu at a restaurant, showing you all the dishes you can order at various prices for a specific day. The main purpose of an option chain is to help you see all the available choices in one place, instead of searching for individual option contracts one by one, which would be very time-consuming and confusing. The option chain organizes everything neatly in a single table. This table is divided into two main parts, one for call options and one for put options. We will learn more about these soon. For now, just remember that the option chain is your go-to guide for seeing what the market participants are thinking and where they are placing their bets. It is a window into the collective mind of the market. Understanding this tool is the first step towards becoming a more informed trader. It helps you analyze the market sentiment, identify key price levels, and make better trading decisions. Whether you are a beginner just starting your journey or an experienced trader looking to refine your strategy, learning to read the option chain is a skill that will serve you well. It provides a wealth of information that, once you learn how to interpret it, can give you a significant edge. So, let's get ready to dive deeper and unravel the secrets hidden within the numbers of an option chain. It's going to be an exciting learning journey. Now that we know what an option chain is, let's break down how it is structured. When you first look at an option chain table, you might see many columns and numbers, which can feel a little overwhelming. But don't worry, we will go through it step by step. The table is neatly divided right down the middle. On the left side, you will find all the information related to call options, and on the right side, you will see all the information for put options. This separation is very logical and makes it easy to compare the activity between buyers of bullish views and buyers of bearish views for the same underlying asset. The most important column sitting right in the center of the table is the strike price. The strike price is the predetermined price at which the underlying asset, like a stock or index, can be bought or sold if the option is exercised. Think of it as the deal price. The option chain lists many different strike prices, usually in ascending order from top to bottom. For example, if Nifty is currently trading at 23,500, you will see strike prices like 23,400, 23,450, 23,500, 23,550, and 23,600 listed in this central column. This allows you to choose the price level you want to bet on. On the left side, we have the calls section. A call option gives the buyer the right, but not the obligation to buy the underlying asset at the chosen strike price on or before the expiry date. People buy call options when they believe the price of the stock or index will go up. So, all the columns on the left, like the premium, open interest, and volume for calls, tell us about the bullish sentiment in the market. It shows how many traders are betting on a price rise, and at which specific strike prices they are most confident about this upward movement. On the right side, we have the puts section. A put option is the exact opposite of a call option. It gives the buyer the right, but not the obligation, to sell the underlying asset at the chosen strike price on or before the expiry date. Traders buy put options when they expect the price of the stock or index to go down. Therefore, all the columns on the right side of the table tell us about the bearish sentiment. By looking at the data for puts, you can understand where traders expect the price to fall to, giving you insights into potential downward pressure on the asset. Let's get familiar with the important terms you'll see in the option chain columns. Think of these as the vocabulary you need to speak the language of options. We'll keep the definition simple and to the point. First is the premium, which is simply the price you pay to buy an option contract. It's the cost of securing that right. The LTP, or last traded price, is the most recent price at which that specific option contract was traded. This gives you a real-time idea of the option's current market value. These two values are fundamental to knowing how much an option costs right now. Next, we have two very crucial terms: open interest, or OI, and change in OI. Open interest tells you the total number of outstanding or open option contracts that have not yet been settled or closed. A high OI at a particular strike price means many traders have active positions there. Change in OI shows how much the open interest has increased or decreased during the current trading day. A positive change means new positions are being created, while a negative change means positions are being closed. These two metrics are vital for gauging where the smart money is flowing. Then we have volume, which represents the total number of option contracts traded for that specific strike price during the current day. While OI shows the number of active contracts, volume shows the trading activity. High volume indicates that a particular option is very liquid and there is a lot of interest from traders today. Another key term is implied volatility, or IV. This is a bit advanced, but in simple terms, IV indicates the market's expectation of how much the stock price will move in the future. Higher IV means the market expects bigger price swings. Finally, you will see the bid price and ask price. The bid price is the highest price a buyer is willing to pay for the option right now. The ask price is the lowest price a seller is willing to accept for that same option. The difference between the bid and ask price is called the spread. For a trader, the bid and ask prices are the most practical numbers as they represent the prices at which you can immediately buy or sell an option. Understanding these terms is like learning the alphabet. Once you know them, you can start reading and forming meaningful insights from the option chain. Now for the most exciting part. How do we use all this information to make trading decisions? The option chain is a fantastic tool for identifying potential support and resistance levels for a stock or index. Let's take a practical example. Suppose the Nifty 50 index is currently trading around 23,500. We open the option chain for the nearest expiry date and look for the strike prices with the highest open interest, or OI. These levels are where the maximum number of positions are open, indicating significant interest from traders. To find the resistance level, we look at the call options side, which is the left side. We scan the OI column for the calls and find the strike price with the highest open interest. Let's say we see the highest call OI at the 23,800 strike price, and it's a very large number compared to the surrounding strikes. This means that a large number of traders have sold call options at this level. These sellers believe that Nifty will not cross 23,800 before the expiry. Therefore, the 23,800 level will act as a strong ceiling or resistance for the market. If the price approaches this level, the call sellers will try to defend it. To find the support level, we do the opposite. We look at the put option side, which is the right side of the table. We scan the OI column for puts and find the strike price with the highest open interest. For our example, let's imagine the highest put OI is at the 23,300 strike price. This indicates that a huge number of traders have sold put options at this level. These put sellers are betting that Nifty will not fall below 23,300 before the expiry. This level therefore becomes a strong floor or support for the market. If the price falls towards 23,300, these sellers will likely buy to defend their position, pushing the price back up. The change in OI column adds another layer to this analysis. If you see that the open interest is increasing significantly at a particular call strike, for example 23,800, it means more sellers are building fresh short positions, which strengthens that resistance level. Conversely, if you see a big jump in OI at a put strike, like 23,300, it confirms that the support is getting stronger. By observing where the highest OI is concentrated for both calls and puts, you can determine a probable trading range for the underlying asset for that expiry period, in our case between 23,300 and 23,800. Beyond identifying specific price levels, the option chain can also give us a broader sense of the overall market sentiment. Is the market generally bullish, bearish, or neutral? A simple yet powerful indicator for this is the put-call ratio, or PCR. As the name suggests, the PCR is calculated by dividing the total open interest of put options by the total open interest of call options for a particular expiry. The formula is very straightforward. PCR based on OI equals total put open interest divided by total call open interest. This single number can tell you a lot about the collective mood of the market participants. So how do we interpret the PCR value? A PCR value greater than 1 suggests that more put options are being traded compared to call options. Since traders buy puts when they are bearish, a high PCR is generally considered a signal of bearish sentiment in the market. For example, a PCR of 1.3 means that for every 10 call contracts, there are 13 put contracts open. However, here's a twist. Extremely high PCR values, like 1.5 or more, can sometimes be interpreted as a contrarian signal, suggesting that the market is overly pessimistic and a reversal to the upside might be near. On the other hand, a PCR value less than 1 indicates that more call options are being traded relative to put options. Since traders buy calls when they are bullish, a low PCR is generally a sign of bullish sentiment. For instance, a PCR of 0.7 means that for every 10 put contracts, there are only 7 call contracts. This suggests that traders are optimistic and expect the market to rise. Similar to the high PCR, an extremely low PCR value like 0.5 or less can act as a contrarian indicator, signaling that the market is overly optimistic or greedy and a correction or downturn might be on the horizon. A PCR value hovering around 1 is typically seen as a sign of a neutral or balanced market, where the number of bullish and bearish bets are roughly equal. Traders often track the PCR over time to see how it's trending. A rising PCR suggests that bearish sentiment is increasing, while a falling PCR suggests that bullish sentiment is growing. By combining the PCR with the support and resistance analysis we discussed earlier, you can get a much more comprehensive view of the market's structure and its likely direction. It's like having a weather forecast for the stock market. Now that you have a good grasp of the basics, let's talk about how you can use this knowledge in your trading. A simple strategy for an intraday trader is to use the support and resistance levels identified from the option chain. For example, if you see that Nifty has a strong support at 23,300, which is where there is high put OI, and strong resistance at 23,800, which is where there is high call OI, you can plan your trades within this range. You might consider buying when the price is near the support level of 23,300 with a stop loss just below it, or you might consider selling or shorting when the price is near the resistance of 23,800. Another key event to watch for is a breakout. What happens if Nifty decisively moves above the strong resistance level of 23,800? This would mean that the large number of call sellers at that strike are now in trouble and will rush to cover their losses by buying. This phenomenon is called short covering and can lead to a very sharp and fast upward move in the market. By monitoring the option chain, you can anticipate such breakouts. If you see the price sustaining above a high OI call strike and the OI at that strike starts to decrease, it's a sign that a breakout is happening. This can be a powerful signal to initiate a bullish trade. To effectively use these strategies, you need access to live or near-live option chain data. Thankfully, there are many excellent and free tools available for this. The official NSE India website provides a reliable option chain that is updated every few minutes. For more dynamic and user-friendly interfaces, you can use platforms like Sensible, which is often integrated with brokers like Zerodha, Opstra, or TradingView. These tools often provide additional features like PCR charts, strategy builders, and graphical representations of open interest, making your analysis much easier and more efficient. I highly recommend exploring these tools. In summary, the option chain is not as intimidating as it looks. It is a treasure map that shows you where the market action is concentrated. By understanding the key terms, identifying support and resistance through open interest, and gauging market mood with the put-call ratio, you can significantly improve your trading decisions. My advice for beginners is to start by observing. Open a demo trading account or just paper trade. Watch how the OI and premiums change as the market moves. Try to predict the market range for the day and see if it holds. With practice and patience, you will become very comfortable reading this map and navigating the world of options trading. Happy learning.